Well, certainly a lot of discretionary ideas sound exciting, right? And they sound exciting because they haven't shown you an equity curve.
People who go down the route of discretionary trading are trying to rush into trading. They can't be bothered to do the work to actually build a system and go and prove that it's profitable over time and then go and build discretion on top of it. So the fear of missing out is the elephant in the room, in my opinion. If you're trading and you've got a fear of missing out and you're worried that you aren't getting involved with opportunities, address that first. Make sure you could either take a load of trades and be very active in the charts but lose money, or you can have a system that you've got confidence in and isn't going to play on your mind when you go to bed at night and generate profit over time. That to me is the goal. I always say, like, if you're in a trade that's keeping you up at night, you shouldn't be in the trade, and it's pretty much common sense. But I think when you're just a discretionary trader, you don't know what's going to happen next. So how can you possibly ever have peace of mind purely trading from discretion? And again, discretionary trading indicates that you're not journaling anything or learning from anything. So how do you develop and grow and progress? Like, I don't know. And I'm not saying that, I'm not saying that it's impossible. And I know there are some great traders that have learned discretionary approaches over the years and they're very professional about it. But most traders, come on, let's be serious. Most traders that mention discretion, they just want to know what the market's going to do. They just want to feel like they just can't be bothered to do the work. That's what I've witnessed anyway, working with thousands of them.
My view is that we need mind, money, and method. We need the multiplication sign in between each of those things. So we need a strategy, we need a mindset, we need our money management, our risk management. You can't do one without the other. They all three are absolutely necessary. So on a strategy, you got to know you have a positive expectancy, whether you do it by back testing or forward testing or whatever. You need to have some sign that strategy actually works. And a lot of people take strategies, they create strategies of their own and they have no idea whether or not it's got a positive expectancy. So they need to either back test it or forward test it, whatever it is, to know that they've got a certain amount of positive expectancy. Then they need to have their mindset. They need to be able to execute those rules consistently. And finally, of course, they've got to have their risk management, their money management rules in place as well. So those three things come together. I don't think it's a question of which comes first. I think they all have to be there, unfortunately. And that's what makes trading difficult. I think this is where your process and your journals come in, right? So if you have a strategy that says, okay, I'm going to analyze the market, I'm going to go with the trend, I'm going to identify the trend, I'm going to go with it, and these are the strategies I'm going to use in an uptrend, these are the strategies I'm going to use in a downtrend, these are the strategies I'm going to use in a sideways trend, and they're very clear about the rules relating to that strategy. So by looking at their journal, they'll be able to tell whether or not they've been executing the rules. It's as simple as that, right? And the same with the money management, which is the same thing as your method in terms of setting out the rules clearly. So for your position sizing, I will not risk more than X%, whatever it might be. So when it comes down to looking at your journal, you can look at your journal and look at your equity journal, look at psych journal and say, yeah, I can see where I did wrong. In this case, I actually should have waited for the market to come into my zone, but I didn't do that. I took it early because I thought it wasn't going to come down. Or I should have waited for my entry trigger and I didn't wait, or whatever it might be. The next question, I think, is the critical one, which is I don't have an answer to, and I think maybe Russell Kennedy might. Why don't we keep journals? I always tell my students, guys, look, take a trade, put it into your equity journal, and you should be preparing it before the trade. You should have your psych journal done. Take the trade, put it into your journal. That, to me, is the most difficult part. And again, this is where Russell Kennedy's coming. Somehow, when we relieve the pain, it's as if keeping a journal relieves the pain. And as one guy said to me, what if I keep a journal, I do everything you tell me, and I still don't succeed? What kind of dummy does that make me? I said, look, think of it the other way around. Keep the journal and you may not be a dummy, right? See what happens. But that I think is the key question. Do you keep a journal? If you don't keep journals, then you're really you're going to find it very difficult to succeed, because journals, I think, are the foundation of improvement and success.
There are very few systems that work in all conditions. Trading, it's kind of like football. It's like one of my favorite metaphors. A football coach doesn't come to the game with one play, because the circumstances are different on every down. In football, you might have 1st and 10. It might be 2nd and short. It might be 3rd and long. And so and what the other team is throwing at you at the moment might change. And so you have to have the appropriate play for the circumstances that are in front of you. And same thing with trading. If you are a trend follower, trying to trade breakouts or trade choppy markets, or your strategy is going to be suited to certain conditions and not necessarily very well suited for others. And so if you've got a system that works under quote unquote normal conditions, cool, but don't think that it's necessarily going to be working, like I said, when things are getting wild and banks are failing and all that kind of stuff, and there are big news announcements that can move markets fast. Don't be thinking that your system that works under normal conditions is going to work now, because that's how so many traders got hurt back in 2008. Is I had a lot of people coming to me and they're like, Brian, what I've been using for, been working for years, I'm getting killed now. There were traders that were losing, 40, 50% of their account because they kept trying to use the same thing, but these aren't the right conditions for that. And so that's the main thing. Like I said, if you're not ready for, for these kind of circumstances, don't go there. It's like going to a rough part of town.
As I said, it really just depends upon your style of trading, and my style of trading doesn't suit the current market, so it's not going to. But going back to what you were going to say, I ran the private limited hedge fund from 1990 to 2010, I think it was. I had 1 year where I had a triple digit, and that was the last year. Generally, it was always around the 20. As I said, I had a 27% drawdown over a 3-year period. So, but generally, and on average, it was, I think, 22, 23%. And that's what most funds do. I mean, some of the funds may do better than that in any one given year. Very few funds, but there are very few funds will be in the 30, 40% mark. I don't know of a single fund that does consistently 60, 70% per annum. I think if he did that, he would get so much money, he wouldn't know what to do with it. But, when you see these things that come out, and I'm not saying that they're false, but it's the focus. They make 70% or 40% in 2 months. Okay, that's true. But what do they do by the end of the year? And what do they do over 5 years? What do they do over 10 years? That's what you've got to look at. Something that works now, the risk, just to give you an example of what I'm talking about. I have a very good friend, and he's a, very hard worker. And he came to me and he said, I'm doing X, Y, Z, and I have turned 78% in 2 months. And I said to him, okay, let's see what you've been doing. And we looked at that, and I said, look, you're taking very big risk. Your position sizing, if it goes against you, you're going to wipe this account out. He said, no, I'm now taking trading to the next level. About 2 weeks after we had that, he started the down move, and within, I can't remember the time now, I think it took 3 months to create that money. In about a month, he lost it all plus. I won't mention how much he lost, but he lost it all plus. So that's what we've got to be careful about. You can make big money trading these large returns, but you're taking risks that, if they go against you, could wipe you out. And first rule I learned: first thing to do is protect your capital when it comes to trading.
Yes, there are certain people. I've got a friend who's a great trader, but he is the type of person who he will take a 50% drawdown, and he swings and swings and swings in the hope that he connects, and he connects and makes back double, triple what he's lost, and that's great. But for most people, they can't do that, and it's purely because it's been studies proven that humans can't tolerate fluctuations more or less than 10%. So, for instance, if you was and this is in anything, by the way, it's not just money. If there was, if you had 10 friends and you lost 10% of your friend group and you fell out with someone, chances are you'd be a little bit, oh, all right, whatever. But if you lost 3 of your friends, you would start to feel a little bit emotional. Same way as if you was paid £1,000 a month and I paid you £900 instead, you might be a bit peed off, but you probably tolerate it. But if I paid you like 800, 700, you'd start to really be like, no, this is affecting me. Same goes for if I paid you more. If I paid you £100 more, you might not be too cocky, but if I paid you £400 more, you might splash the cash and drinks on me and quickly get rid of it, right? So you become a bit cocky. Same goes in your trading. When you're trading fluctuations greater or less than 10% in your equity curve or the volatility in your account, you're going to struggle with that. So what I would say to your question is just assume, if you're starting, just assume that you can't take more or less than 10%. And then if you find out that you can, then great. But just be aware that if you lose 50% of your account, you've then got to make back 100% of your account. And that's pretty hard to do. The quickest I've doubled my account in is just over 18 months. So, 19 months to double my account. And I did that. But that was the quickest I've ever done it. So just bear that in mind.
Avoid the temptation of doubling up on your 21st trade, right? Do you think, I've had 20 losing trades, right? Well, the 21st has to be a winner, right? Avoid doubling up. Yeah, there's no magic wand on how to come out of a drawdown because you have no control over what the market will do or what your strategy will do. What we have control over is the exposure that we have to the market. We've got to minimize that as we're losing, and we've got to be patient. We've got to be patient. If you trade a good strategy, it will eventually, come good, and you'll be alive. You'll catch those trades. You may not be trading at your full size because you had to, reduce your position size because of the drawdown, but your strategy will reach a new equity high. And it will continue, and you'll be able to build up your position size. The account is moving up, and off you go. There's no magic. I don't know any magic formula or trick, to basically trade out of a drawdown effortlessly. I don't know. But if you survive a drawdown, like intuitive, a trader will get so much confidence from that. God, I've done that. How good is that? And they'll be so well suited to be successful going forward because they've experienced and survived the first one. Just got to be patient. Be patient. Just trade small. Stick to your rules, and you'll be surprised. And when you do get a profitable trade, don't be anxious to bank that profit. Oh my God, it's a profit. I'm gonna close my position because I haven't had a win for a long time. Stick to your trade plan, okay? If you're a trend trader, let it accumulate. Yeah, you'll be a strong temptation to make that profit, right? Because you've been experiencing so many losses. But it's all about sticking to your plan, right? I'm just telling you, you'll have temptations, and I have temptations, and I just say no, don't.